I met Justin specifically at it was the same people who run the North American Bitcoin Conference. It was a blockchain world conference in New York. And I was in the girls' bathroom, and there was a sign on the door that said that this is a guys' bathroom. And every time I'd walk in there, there'd be a guy in there, and it just made me so mad that I ripped the sign off the front of the door, and then I got in trouble, and they were like, you're gonna get, they were gonna kick me out or whatever. Anyways, I vented to Justin, and we became friends ever since then. Yeah, it was really frustrating. But anyways, so you guys all know that Bitcoin is its own blockchain, but there are also multiple blockchains. Ethereum is its own blockchain, but all blockchains are susceptible to a 51% attack, right? And the more decentralized a blockchain is, the less likely it is to get this attack. Now, with Bitcoin being the most decentralized blockchain, these two guys here have figured out a way to make it work better for every other blockchain. So, without further ado, I'm going to introduce you to, I'm going to let these two guys talk and ask good questions. This is
hi, everybody. Thanks for having us here tonight. Should we get centered or stay to the side? Where do you want us standing? You don't want to block the... You
can sit if you'd like, if you want to be in the live stream, but if you're both there, you're both in the live stream.
Right now, are we good?
Yes, sir.
Okay, so hi, everybody. We did prepare a presentation that Max is prepared to present on what we call proof of proof. It's a new consensus protocol. We're still a little jet lagged. We just came back from a little Asia tour. We were in Singapore, Vietnam, and Seoul, Korea. Learned a lot. It's my first time in Asia as well as Max's, and it was an exciting trip. So there's a couple ways we can go about this. I think we've got, someone correct me if I'm wrong, I think we've got about 45 minutes. So we don't have like preconceived notions about how we're going to do the event. It's kind of more of a casual, we want to kind of create more of a one-on-one atmosphere so people can ask questions and we can give more in-depth answers than what you might typically get on Twitter. So just a quick show of hands, just to kind of get a feel for the audience, and this may be a little silly, but I don't know, I know Art Basel's going on right now, so there may be some people here who have never heard about crypto. How many people in the room, know Bitcoin, or you have Bitcoin? Probably this would be a little quicker. Who's really new to the entire blockchain space? Okay, good. So we've got a really educated audience tonight. This is going to be great. Since we have a really educated audience, what I'd propose is that, Max, you go ahead and give a presentation on proof of proof. I'm here to support you, maybe provide some kind of like layman explanations of stuff you might go into more detail on. And then we can pause throughout the presentation if people have questions as we're going through the presentation instead of saving everything for the end. But there's basically like 3 or 4 segments, and at the end of each segment we can just take a minute and see if there's any questions, or we can march through it. So it's really up to you guys. You guys are going to be the you're going to set the temperature and the pace. So without further ado, my co-founder and co-inventor, Maxwell Sanchez.
Hi everyone. So today we're talking about what proof of proof is, and to give a really high-level overview, you've all heard of Bitcoin, clearly, and Bitcoin is the world's most secure proof-of-work network in existence, and so we set out to design proof of proof basically to allow other blockchains to benefit from that security in a mutually beneficial manner with Bitcoin, and without losing the properties of Bitcoin and proof of work that make it so great, the decentralization, the trustlessness, the transparency, and the permissionlessness. So like Justin said, this presentation is a little bit informal. We do have some content to go over in the slides as kind of a backbone and talking points, but if people want to spend more or less time on a certain topic or are particularly interested in something, just let me know during the presentation and we can do a deep dive. This is meant to be a little bit more high level, so if you have really detailed technical questions, we might be able to do those more on a one-on-one session rather than dragging everybody through that. And so I'll try to keep this as kind of middle of the road as possible while still providing some interesting detail. But before we talk about proof of proof, I need to figure out the controller. There we go. And before we talk about proof of proof, I'd also like to talk about real quickly what Bitcoin is, what proof of proof and proof of work are, and really the innovation that Bitcoin brought to the whole space when it launched. So Bitcoin, a lot of people, you ask them, what made Bitcoin so revolutionary? Why is Bitcoin such a big deal? And they'll come up with something like, oh, well, it's decentralized, it's peer-to-peer, it's replicated on a bunch of nodes, and everybody stores a copy of it, so it's secure. And these things are all true, but they kind of miss the whole point of what Bitcoin brought to the table that didn't exist before. Bitcoin didn't invent peer-to-peer protocols. It didn't invent decentralized networks. What it did is it made a whole new class of actions possible on a peer-to-peer network that we couldn't do before. BitTorrent launched in 2001, and before that, there were other peer-to-peer networks. Bitcoin, however, found a way to do something that's really, really unique that we didn't really think was possible given the decentralized peer-to-peer nature of mesh networks and things of that nature. So what did Bitcoin do? Well, in the real world, if I have a bar of gold or a dollar bill with a serial number on it or something, physics is pretty good at preventing that object from spontaneously turning into multiple copies of itself. If I have a bar of gold and I give it to you in exchange for services or goods or whatever, I no longer have the bar of gold, you have it. And I could find another bar of gold and give that to somebody else, but it's a different bar of gold. And this brings up a problem when we try to do that on a computer network, on a digital system, because computers are really good at duplicating things. Every time when I sent these slides in, I didn't send the slides, I sent a copy of the slides. And then when they downloaded them, they created a copy of the copy, right? That's what computers are good at doing. That's why computers work. Everything is a copy of a copy of a copy. So how can you have unique assets in a digital system? In a peer-to-peer network, originally something like BitTorrent or whatever, the torrent protocol, it's really, really good for copying a file into a lot of different places. If I create some royalty-free music that I want to share with the world and I put it on BitTorrent, everyone can share it and everyone can download a copy, and that's great. But what if we want to create something where we have uniquely attributable assets? I own this dollar, I transferred that dollar to somebody else, they now own it. Computers aren't really good at doing that normally, and that's where the innovation of Bitcoin and proof of work came from. Proof of work, for the first time in Bitcoin, made it possible to have a unique digital asset that could be transferred between two users in a verifiable manner, and make it so that every single person in the world, even if they don't know, like, or trust anyone else in the network, could independently come to the exact same conclusion about who owns what asset at a certain point in time, and how is it transferable, who can it be transferred to, and in some cases even what it's worth. And so proof of work, how many people are familiar with how proof of work works? You've heard of Bitcoin mining. Okay, so I'll do a quick explanation of it. Basically, proof of work is a way to conveniently elect people on the network to create a block in a decentralized manner. So Bitcoin solves something called the double spend problem, which is that duplicating a bar of gold type of thing. If I have a bank account with $100 in it and I write two different checks, one to Joe for $60 and one to Jane for $60, each of those checks independently looks perfectly valid. It's a legitimate check, it's signed correctly, and even if you look at my bank account, you see there's $100 in the account, the check's for 60, it should be fine, it should clear. But those two checks cannot both coexist. Only one of them can ever get cashed, right? The other one's gonna bounce. And so what proof of work does is it says, well, the authority in a check with, writing checks and stuff, the authority is the banking system. The banking system at the end of the day tells you this check cleared, that check didn't. But how do you do that if there's no single person who's responsible for deciding whether a check clears or not? That's where proof of work in Bitcoin comes in. Proof of work is a way to say, all right, this person is able to decide for this time slice, essentially, it's a bit of a watered down version, but for this time slice of time, this person chooses which of these mutually exclusive transactions are able to be processed, and they put them into a block, and they give that block to the network. And so this proof of work for Bitcoin is very, very highly consumptive of energy. It uses tons of power. Right now, every block on Bitcoin, depending on who you ask, takes about 500 megawatt hours of power, which is roughly what 500 to 1,000 US households use in about a month, depending on the season. So that's a lot of electricity, and it's securing those transactions, because in order to overwrite something in the blockchain, you would need to expend that same amount of power creating alternate blocks and trying to challenge that alternate history. So that's why Bitcoin's so secure. And proof of work, the way it's designed, it's decentralized, trustless, transparent, permissionless. That means anybody can go and start mining at any point in time or stop mining. And everyone can see when someone mines a block, what's in it, what did they mine it with, and it's permissionless. Anyone, of course, can join the network, and because of that, it becomes decentralized as people naturally step in to collect the rewards that are paid out by the network for mining. And so some quick numbers on Bitcoin security. Right now, it uses about 3,500 megawatts of power, which is an absolutely insane amount. It's about 80,000 petahashes, which, how do you even quantify that? But that's done by over $3 billion worth of computational hardware. So to attack the network to 51%, to have half of the total Bitcoin power under your control is extremely both cost prohibitive and logistically prohibitive. But other chains aren't quite as secure. This is a chart showing, based on current hash rate rental fees, how much it costs to attack different networks. So it's kind of hard to read. Here we have Bitcoin, a little over almost $3 million an hour. You have Ethereum between 500 and a million. And you have a lot of other coins in the long tail, Bitcoin Cash, Litecoin, Zcash, SV, Ravencoin, even Ethereum Classic, that are a fraction of a fraction of that. Some of them are down to $20, $30, $40,000 to attack for 6 hours. What does that mean? You could send a transaction, let it percolate and sit on the network for 6 hours, and then claw it back and steal it. And this isn't just a theoretical issue. People have been doing 51% attacks for years now very successfully. In 2018 alone, over $18 million, $20 million were stolen from exchanges through a bunch of 51% attacks. And actually, even just yesterday, another chain called Vertcoin got 51% attacked for a second time. And so, again, not theoretical, it's really happening. People are losing real money to this. And it's not because the exchanges did anything wrong necessarily. It's because the way that these decentralized consensus protocols work, it's possible to attack them and rewrite history arbitrarily if you're willing to pay enough money to do the attack. And in many cases, it's not only possible, but extremely profitable to do so. And so how can we improve the security of other blockchains, right? Bitcoin can't do everything for everybody at every point in time. There's not enough space. It's feature incomplete for a lot of things people want to do on top of it. So there's naturally going to be other blockchains that have their own consensus protocols, their own asset types and classes, their own smart contract features or whatever it is. There's a demand for multiple blockchains that do different things. Some of them serve specific users or specific use cases. And what can we do to make that ecosystem overall much, much more secure? Well, we can use Bitcoin. We can leverage the power of Bitcoin that it's already amassed and that it already has committed. And we can add value to Bitcoin while we do this by taking a portion of the value of these chains that we're securing and essentially moving it up the food chain to Bitcoin. How do we do that? Well, a simple way is, what if we just said, okay, you have a blockchain, you call it Breadcoin, you launch it, it has some proof of work, and it's vulnerable to 51% attacks, right? You can go on some nice hash site or Amazon AWS or whatever, and you can run a bunch of computing power and you can attack this network pretty easily. And maybe it has $10,000 in trading volume a day on an exchange, and it costs $100 an hour to attack. You can take some coins, deposit them on the exchange. A couple $100 in, you're able to steal $10,000, $20,000, $30,000 worth of value from the exchange. And so what if we took this blockchain and took fingerprints of that blockchain periodically and stuck them on Bitcoin? Now, that's not necessarily a new idea. People have been sticking data on Bitcoin to secure it since 2011, 2012. And it's a very good way to immortalize the state of data at a certain point in time. You've probably heard of a multitude of different products that basically take the hash of a file or something and put it on Bitcoin. And then in the future, if anybody says, oh, here's the version of the contract that's correct, or here's proof of this file or that file, you can hash it and compare the fingerprint of that file that's claimed to be the correct one versus the one that somebody published to Bitcoin a year ago and see if they match. And so we can do a similar thing with blockchains. Blockchains are really just digital data. We can take fingerprints of a blockchain at a certain point in time, and we can basically just funnel it up to Bitcoin and take a little snapshot of it. And then if it's ever challenged, we can look, well, what did Bitcoin, what state of this blockchain was published to Bitcoin 6 hours ago or a day ago or a week ago? But how do we do that in a way that's decentralized, right? Because who's the person who puts these transactions here? Do I do it? Does the developer of the chain do it? Does an exchange do it? Does everybody do it? And who pays for that? It costs money to do Bitcoin transactions. At peak, Bitcoin transactions were between $50 and $100 for a high priority Bitcoin transaction. So it's not cheap, it's not free. People aren't just going to do it out of the goodness of their heart. But who gets to put that there? Is it a permission system? Is it something where you have some fingerprints up to Bitcoin. And everybody can look at the fingerprints on Bitcoin and see, oh, somebody's building an attacking chain. It looks like this. It started here, and it's still a threat because they're still building it. And so an exchange isn't going to confirm your deposit. Or if you're buying a car from me, I'm not going to let you drive away in the car until I look at Bitcoin and I see that there's no attack pending. There's nobody publishing attacking blocks up to Bitcoin for this alt chain. And if I wait long enough, I get something called Bitcoin finality, which tells me, well, there were no competing forks published to Bitcoin within a certain time frame. And so I know for sure that nobody can go and actually attack the chain and rewrite history at this block, the block I care about where I received the payment for the car or whatever, unless they rewrite the history of Bitcoin itself, which is very, very expensive. And so while the data is publicly available and it's easy for everybody to look at in theory, obviously you have to have end user tools that make it possible. And so that's where something we call EAD or early attack detection comes in. It's basically a lens with which to look at the Bitcoin blockchain through to see if there's competing publications for a certain blockchain that you care about. Justin has a good analogy for this. Do you want to step in and give a...
Which analogy? Oh, just you can take it. The one about the
security cameras?
The criminal who wants to rob your house has to call you first.
Yeah, so EADs, yeah, so EADs like basically...
You can see them on Google Maps, what their location is they're attacking as they're moving toward attacking your house. So.
Yeah, so EADs like, somebody can still break into your house, but it's like they have to call you ahead of time, let you know they're going to attack your house. You can see them on Google Maps. The police are already there when they come. That's EAD. So it doesn't prevent reorganizations, but it tells you when one's going to occur or if one cannot occur. And so on a chain, 99% of the time, the blockchain's not getting attacked. And so after a short waiting period, you're going to get confirmation that there's no attack occurring and an attack is impossible. Therefore, you don't have to worry about getting double spent at all. Whereas normally with these, especially smaller blockchains, but even large ones, Ethereum Classic got hit for $500,000 that was stolen. And Ethereum Classic's a pretty large chain. Some of the other chains, there's a site, it's currently down unfortunately, but it's a really good site. It's called crypto51.app.app. And it's basically the coin market cap for security. And so it shows you how much it would cost to attack any single proof of work blockchain at a certain point in time for 1 hour or 3 hours or 6 hours or whatever. And it also shows you whether all that hash power is available for rental from one of the popular rental sites or not. And you can go and do the math yourself to figure it out when the site's down, but it's eye-opening because you can see that there's chains where it would cost $5,000, $10,000, $20,000 to do a 6 or 12-hour reorganization, which is way more than the number of confirmations major exchanges are requiring for those chains, and the chains have millions of dollars a day in trading volume. So you could easily deposit $1 or $2 or $5 million worth of this coin, trade it out for Bitcoin, and spend 20 grand to perform a successful double spend attack. So the issue certainly there, EAD is an easy way to get access to that information from an end user perspective. And the essential idea behind EAD, if it was used by an exchange or a merchant or whatever, is that when you receive an incoming transaction on a chain that you think could be attacked, which is pretty much every chain, then you would look at EAD and you would wait until that transaction achieves Bitcoin finality. And Bitcoin finality means there were no publications of the alt chain up to the lag time that's allowed by the protocol. And so because there's no attacking fingerprints in Bitcoin, any fork that's proposed to the alt chain network is going to get automatically rejected by the consensus protocol. You know that the transaction is as safe as a transaction on Bitcoin itself. It's actually more safe than a transaction on Bitcoin because not only would they have to 51% attack Bitcoin, they'd also have to simultaneously 51% attack the alt chain as well, and they'd have to do those two in concert at the same time. So EAD gives you a view into are attacks occurring and what blocks are known guaranteed to be safe. And once they reach that finality, perfectly fine to accept. So that's another quick view of EAD. This is EAD when an attack's not occurring. You can just see normal alt-chain publications, everything's fine. And so, this was the old version of the image. Eventually the blocks below it would have like a Bitcoin logo +1, Bitcoin logo +2 saying, the blocks and transactions in this block are as secure as transactions on Bitcoin with 2 confirmations or with 5 or 10 or 100 or whatever you want to wait for. Proof of proof also doesn't just work with proof of work chains. It works with proof of capacity, proof of stake, delegated proof of stake, any decentralized or semi-decentralized consensus protocol. Proof of proof is basically additive. So you have your existing consensus protocol of your network. You have some way that people on the network make blocks and come to intermediate consensus and agree, yeah, this is what the network looks like, these are the transactions that are happening on it. And then proof of proof layers on top of it and gives those blocks Bitcoin finality by getting those publications up to Bitcoin and securing the network. And so proof of proof is purely additive. It lays on top of an existing protocol and reinforces it with the power of Bitcoin. But you still have the native security. You didn't give anything up in the adoption of proof of proof. And so one quick slide on what we're doing at Verablock as far as, so that's the consensus protocol, proof of proof, POP. And then we created a concrete implementation of proof of proof called the Verablock blockchain. And so the Verablock blockchain is basically its own blockchain with its own native proof of work that is the first to implement this decentralized proof of proof consensus protocol and secure itself to Bitcoin. And then since Verablock, the blockchain, is now as secure as Bitcoin, it has Bitcoin security from proof of proof. Other chains can do proof of proof up to Verablock instead of up to Bitcoin. And this is a lot more cost effective. You also get the added benefit of the native proof of work security of the Verablock blockchain itself added on top of what you're getting already from Bitcoin. And it's also a lot easier to adopt because we're rolling out libraries and reference implementations that show you exactly how to layer this technology on top of things from, say, the Bitcoin codebase family or the NXT codebase family and other codebase families as we develop those and put out reference implementations. Plus the exchange integration. So the EAD metrics that I mentioned earlier, they're a very extensible software suite. And so basically, if you're listening to EAD for Verablock, any blockchain that joins the Verablock ecosystem, you can just simply plug in a config file, and that EAD is now aware of all of the Verablock altchains that you care about as an exchange. So instead of having to set up separate EAD instances for every single altchain that you list as a payment processor or as an exchange or as a merchant or whatever, you just have one single EAD instance that looks at Bitcoin and the Verablock blockchain and is able to look at all these publications and decide whether any particular chain's under attack, send out alerts, freeze deposits and withdrawals, freeze trading, whatever makes sense for your use case of the blockchain. In the event that it is being attacked, you can just plug right into EAD and it solves it for all the chains that are in the ecosystem. Do you want to jump in and?
I mean, we should probably pause for questions right now.
I think that's, yeah.
How much time did we spend on that? Anybody watching the clock?
15 minutes, 20?
How many minutes? Anybody know how long that was? About 25, I think about 30 minutes? Yeah. Okay. So, yeah, we could open for Q&A if anybody's.
Yeah, so when it comes down to the miners for Bitcoin, does this incentivize them? Does it affect them at all?
It does, yeah. So everybody who's doing this proof of proof mining is paying Bitcoin fees. And so the way the economics work out is basically you have a blockchain that's using this proof of proof consensus protocol, and it has a certain number of coins that are paid out to its miners every day, right? Either from the Coinbase transaction and the block reward or from fees on the network or a combination of the two. And a portion of those fees are diverted to proof of proof mining to incentivize people to do this consensus protocol. And those are essentially converted into fees on the Bitcoin network. So if a blockchain that's paying $10,000 a day for its security overall is paying maybe 10% or 20% of that to pop miners, to say it's $2,000 a day, that percolates up through proof of proof mining at a pretty high conversion efficiency into transaction fees on the Bitcoin network that directly incentivize Bitcoin miners to include them in their blocks. So basically you have Bitcoin miners are able to now capture a portion of the block rewards of every other altchain that uses this system because they're flowing up through into Bitcoin. If the protocol pays you $100 to publish something and it costs you $90 to publish it, you're going to do it and collect the $10. And in turn, you're giving 90 of those dollars to the Bitcoin miners. And so essentially, Bitcoin miners now collect fees from every single network that uses it for security. Uh-huh.
What's your go-to-market strategy? Because I don't really see a lot of the existing protocols. There's a lot of governments that has to go on to, let's say, adopt this new proof of proof to kind of lay on top of their existing consensus mechanism. How are you approaching, actually onboarding these developers to use this?
Well, interesting part about our ecosystem is that it's based on permissionlessness. So fundamentally, our first instinct would to be non-contentious. But we certainly plan on writing numerous reference implementations of all the various major projects that are out there. And then the individual communities can decide if they would like Bitcoin finality. The way I like to look at it is Well, there's a few answers to your question, but the first is that the ecosystem is permissionlessness. It's based on permissionlessness. And the second is, we're building right now what we call the, and we don't really want to talk so much about the project. We don't really like to market per se. We really would kind of try to focus more on the tech, but I'll generally answer your question and say that we've been working aggressively since April, building what we call the Verablock alt-chain integration factory, right? You got to have acronyms because a lot of these things take a long time to say. So the idea behind VAIF is that a given blockchain that was built or forked from a given species, i.e. Bitcoin, could literally in a day have an MVP testnet that integrates Verablock end-to-end all the way up to Bitcoin testnet and back, and begin immediately testing their blockchain with this new consensus protocol. We also believe that there's going to be some projects who use proof of proof directly to Bitcoin and circumnavigate Verablock. Regardless, over time, aggregation of proof of proof and having a layer is going to continue to, excuse me, I think we need to get more in. So, excuse me. So VAIF is one of our key go-to-market strategy as far as encouraging adoption. We're going to make it lightweight and turnkey as possible for a would-be blockchain or any community member of that blockchain to implement and begin testing and exploring whether or not it's right for their community. How do we make money? Well, there's a couple ways we make money. One, we are fundamentally a blockchain development company. So we have a strong development team, and we also do software development as a whole. So we do have a revenue model as a company doing software development. But primarily the blockchain itself, in regards to how we make money, would be through creating value. So if what we're building is going to genuinely create value for the ecosystem and it's adopted, then fundamentally the use case for the Verablock project would increase. And if that happens, we would benefit from that, as well as anybody else who, well, it's not a token, it's a cryptocurrency with a token, it's got a utility. But just in the same way that, I don't know that, when you say, how do you make money, what's our incentive? Our incentive is twofold. Obviously, making money is one of them. Saying otherwise would be disingenuous. But Max and I had a lot of opportunities to make money. We had $50 million committed, and we refused to do a SAFT and an ICO. We didn't like the model, and we felt that it had some holes in it. And we prolonged our launch, and we feel proud about that. We focused on the technology, and we're paying dearly for it, right? So it's fundamentally, we have a long vision about where we think the space is going to go. We think fundamentally that proof of work in aggregate is more beneficial to the community than segmented proof of work. And that if you can create an ecosystem with a convection current of value where instead of alt chains or shit chains as they're often referred to, instead of them competing against Bitcoin, they can complement Bitcoin. Now, that would be through the fee structure, and there's a lot of controversy around that. But fundamentally, Max and I had deep discussions about this. This goes back to 2015. We've been working on this project for 4 years. It's not, and we did it with our own money and took a lot of risk. So, yeah, I've got no apologies in regards to the path that we've taken and where we're going. So I'm proud of what we've done. We're chock full of capital. We're really strong right now. We did an IEO in April 2nd. We had a record-breaking IEO. There were some things that didn't go as well as we'd like. It was the first IEO, certainly on Bittrex. We helped, create the structure, and there was a lot of enthusiasm around the project. I don't really like to talk about price because that's not something that we can control. If you look at our volume, you can see clearly that we don't play any games. There's no market manipulation and things like that. Our strategy is to simply focus on the tech, try to find projects that want to get security, that want Bitcoin finality to protect themselves, and rinse and repeat, and make it easier and easier and easier and faster. Adoption and price are things that, especially price, like I don't even like to talk about it, but it does play a role in the ecosystem, because if our price isn't sustainable, then people aren't going to spend Bitcoin in order to do this transaction and receive Verablock. So it does play a role in the technology itself, and to that extent, I'm comfortable speaking about it. Yeah, I hope that answers your question.
Is the Lightning Network, how do you combat the Lightning?
Well, we like to see our technology as a complementing technology, not a competing technology. But in regards to Lightning, we've had a lot of talks with Adam Back. He's a big proponent of that project. We talked about the different situations. I can't go into much detail on it, but there is a situation where, there's a lot. I don't want to break out into a debate at a meetup, but fundamentally, as I understand it, there are some issues with Lightning in regards to anybody running a node can be a money service provider or money service business. That's something that needs to be looked at. Fundamentally, law is going to play a role in the blockchain space, whether we like it or not. We've certainly been riddled by it. But I don't have a dog to fight in the Lightning thing. I hope it works and propagates. I mean, it's great. But the one thing that Lightning, if transaction fees continue to rise on Bitcoin, then getting in and out of a channel fundamentally could lead to centralization, as only players that can afford. I mean, who knows? There could be a future where the ability to get in. The way I like to say it is in a proof of work model, people compete to make the block, right? They expend resources to make the block and earn the reward. Proof of proof builds upon that paradigm exactly, in the sense that proof of proof miners compete to get in that block. And fundamentally, it's following the same principles that makes what we consider proof of work great. I don't see proof of work as anything wasteful at all. I think it's one of the most profound things that I've come across in my technical career. And I've seen some things. It's definitely up there. I think it's clearly changing the game in the landscape of the financial markets and the ecosystem as we know it. And I'm fortunate to work with Max. I mean, I'm kind of more of a high-level idea kind of guy, get a vision. But trying to execute any of this stuff without somebody with Max's expertise would be nothing short of ludicrous. But as far as Lightning's concerned, there's a situation where if fees get prohibitively expensive, the casual investor or casual user couldn't open and close a payment channel without exorbitant costs. There's also the possibility that, in a rare circumstance, I suppose, just speaking logically, you could get trapped inside a channel because you paid the fee to get in and open your channel, but then the fees went up because of a spike in network traffic, and now you're kind of locked in. You can't unwind your channel. And then what happens is you're kind of turning control over potentially to the Coinbases of the world, who can afford in aggregate to open and close channels. So I kind of look at Lightning, which I think is a great idea. I think payment channels are really, really interesting. But I think when you look at Lightning, I don't consider Lightning Bitcoin. I considered it encumbered Bitcoin, would probably be a better way to look at it. Because until you get it back into Bitcoin, it's not Bitcoin.
I'll take a stab at that one too.
Here you go, excuse me.
Finality of the Bitcoin blockchain.
Mm-hmm.
Okay, how many minutes you need to, on average, to say that Bitcoin transaction is final?
Are you talking about proof of proof ignored just Bitcoin itself?
Just Bitcoin itself.
So finality is an interesting word.
Don't give me
Yeah, I'll keep it short.
time approximately.
I'll keep it short. It depends on what you're using it for. The general consensus is people like to wait 6 Bitcoin blocks, which is roughly an hour. Bitcoin block time is variable. It could be 20 minutes, it could be 2 hours, it could be 5 hours. And it really depends on your luck with Bitcoin mining.
You just mentioned 1 hour for 6 blocks of Bitcoin.
Yes.
After that, proof
So proof of proof, when you layer proof of proof on, you have an additional waiting time because there's a variability, and I won't go into all the details, but basically you have to give an allowance for an attacker being able to manipulate difficulties in certain ways, and there's a lot of other factors to consider. So proof of proof generally is going to be somewhere between an hour to 2 hours, depending on the exact implementation, the chain's own consensus protocol, how responsive it is to increases and decreases in hash rate.
I'm an attacker, for example, and I want to attack within the first 40 minutes. And this will be enough for me to attack the alt chain, and at the same time, because finality of Bitcoin network not ready yet, so you cannot prevent this. So how proof of proof can at least, the idea is great. I really like the idea that you're presenting, but there is certain kind of vulnerabilities.
Yeah, so it comes down to when do you confirm a transaction, right? If I'm an exchange and I have a high risk asset, and high risk, most of the blockchains today are high risk. I mean, Ethereum Classic, Bitcoin Gold, Raven Coin, all of them are high enough risk and high enough volume that an attack on almost any of those is quite possible. As an exchange or a merchant or somebody who is deciding when they confirm a transaction, right? Because the transaction's confirmed by the network pretty quickly, but when do you consider it safe to accept? When do you deliver the product? When do you let the user trade, right? You're going to set that based on your own risk profile for how large the transaction is, how much it costs to attack the network. What you can do if you're not sure is you can wait the full hour to 2 hours to get Bitcoin finality from proof of proof. And at that point, it's extremely secure. Up until that, you get probabilistic information. You know that an attacker would have to expend a certain multiple of the altchain's hash rate to be able to create a blockchain and retroactively insert those transactions and catch up with the main chain. In a proof of work chain, as a simple example, say you're Breadcoin and you have your own proof of work and you wait, say, 40 minutes, right? And you start building your chain and doing these proof of proof transactions after 40 minutes. The transactions you do to Bitcoin when the proof of proof, the fork resolution algorithm, basically the algorithm that looks at the current chain and looks at the attacker's proposed chain and compares them and says which one's the right one, that algorithm is going to punish the late publications quite severely. So the publication timeliness of the attacking chain to Bitcoin, for example, if you're securing directly to Bitcoin, or to Verablock if you're using Verablock, the publication timeliness is really important for fork resolution. So if you publish your attack as you're building it early on, then you announce to the world you're attacking it in the first 10 minutes. So you can't really do your attack. If you wait 40 minutes and you start doing these publications, the fork resolution algorithm is going to weight those publications a lot lower. So in order to catch up with the main network and get a score that would allow you to actually perform a reorganization or a 51% attack, you're going to have to start producing alt-chain blocks much, much quicker than the network. So you might have to be able to do a 300 or 400% attack, or a 4 or 5x multiple to be able to start to outrun the chain and get your publications to start being in step with the main chain.
I understood from your explanation that publication means that you sending blocks to Bitcoin network. Is that what? Correct?
Correct, yeah.
So I'm not saying anything to Bitcoin network. I'm attacking just altcoin network, right? Without any publication. I'm taking 51% control of altcoin nodes,
Gotcha, okay.
I will not publicate anything. So
Yeah, if you don't do any publications, your attack will be rejected by the network. If there is a legitimate chain, Bitcoin finality says that nobody can do an attack and do publications and reorganize the network. But before you get Bitcoin finality, you still have Bitcoin protection because it's just not absolute. Essentially, the way it works is if you have your main chain, it's been published up to Bitcoin. Every time a block's made, its fingerprint gets published, everything's good. And then an attacker generates a chain offline, say 40 minutes of blocks offline from the network, and they release it to the network. The network's going to reject that fork because that fork doesn't have any publications to Bitcoin versus the main chain does have publications to Bitcoin. When we talk about Bitcoin finality, what we're saying is if that attacker started doing publications to the Bitcoin network, then could they outrun the chain and get it accepted?
may I rephrase simple way? Am I correct or wrong? If attacker starting to do attack without finality on a Bitcoin network, it means that it will be rejected by the altcoin network because there was no publication yet.
Correct. Yes.
Okay, we can continue those technical details later.
One question from this gentleman who was waiting.
One more
Just a very short one. Just one thing about, because you said about the website where you can calculate how much to ask. Is it safe to then assume, just to say that the only reason why a lot of blockchains are standing today is because organized crime hasn't entered here yet? Because if it's a simple matter of investment in order to make a whole bunch of money, that just means that the attackers aren't a very organized bunch of them.
You want to take this? I'll speak really quickly to, there have been between 10 and 15 of these attacks successfully that have stolen money. And so it isn't just a theoretical thing. People are really doing this. I think a lot of it comes down to,
No, but I'm meaning like serious people, like criminals with a bunch of money already, like as in like a mafia type of thing. They're realizing just doing the simple calculus that if it costs 200,000 to do a 2 million type of thing, and they'll just like start pumping these every other day, as opposed to like a few in a year type of situation. If the profit motive is that, it just means that real organized crime is not here yet. That's what I'm trying to say. Is that the case or not?
We don't have a dog in that fight, right? I mean, that would be us subjectively interpreting how we think organized crime operates, what they're up to, what they're thinking. Fundamentally, the facts speak for themselves. There's been numerous 51% attacks. They've done the exact attack that we just described. They've done it to some chains that would have otherwise been presumed generally secure. So the facts, I'd rather than being, interpreting what I think, I try to focus more on what we know to be the facts. The facts are that depending on the amount of confirmation time an exchange is willing to let you start using the money, in conjunction with what it costs to attack a given chain, as well as what other security precautions the exchanges have put in place in order to counter these types of attacks. And for all we know, the stage could be getting set for a major 51% attack. So to your point, I think this issue is going to become more and more important. I know this. I would put it to you. Here's a better analogy. I know right now if I go back to where I live and I went and checked every single door in my neighborhood, some of them are open. I probably don't want to be walking around my neighborhood checking doors, and when I get caught, say, well, I was just doing a good deed and a good service for all the citizens of my neighborhood, making sure that you were safe and secure. The point is that I think the ecosystem and its given communities each have a responsibility to do what they can to protect the communities that they've been, promoting to and providing value to. Again, proof of proof, fundamentally, when you step back and look at it, it's really simple idea. It's not a complex idea. And it follows the principles of proof of work. So when you look at the nature of what we're doing, there's people who accuse us of spamming the network, et cetera. But I don't think that that's really looking at the facts. If we think of it, somebody else could have thought of it. So that genie's not going to go back in the bottle. So yelling and screaming about whether something is a spam transaction or not is irrelevant. And if Bitcoin can't change the protocol or change its nature, and if they do, another chain may want to continue with this and allow it to happen and accept the spam. So this is so early in the space to try to pick, a dog in the fight is just ridiculous, with the exception of the world's greatest aggregation of proof of work, which is Bitcoin. Fundamentally, I think we're proof of work maximalists, fundamentally, from a security perspective.
That's sort of what I was doing. My point is that the organized crime isn't here yet is your strongest marketing sort of point of view right now. Since it's not here, and what you guys are doing, as far as I understand, you might be the first. So you're already implementing the solution before the problem has become a real problem.
And we're making that adoption easy, and people can join the community and test it. And we missed a couple quarters on our deliverables as far as when we wanted to get things out. We just got funded in April. You can't even really touch the money right away. There's a lot of logistics. You've got to do so many other things before you can even get to work. And then when you add and you build up your team, there's a lot of personalities, and you've got to go through people until you get that magic happening. We've hit our stride. We've got our magic happening right now. Tim Stahl, who's our Chief Development Officer, I've known him for over 12 years, and he's worked on major enterprise projects. He's a world-class, he's a first-class person who happens to know tech and development really well. We also had some great help from a gentleman named Josh Rack. These are top-notch guys. We've got a great team in Eastern Europe that we've been working with, and everybody's starting to gel. So I really like where we're at, and I think that Q4 here and Q1, I encourage everybody to come and visit the project and learn more about it, because we've got some really exciting things happening. There's a lot of bullshit in the space, and I think Max and myself and the team that we've built, we're proud of what we've done, and we're not going anywhere. We're long.
So one last question from online. Who do you consider to be your main competitor, and how do you primarily differentiate yourself?
So main competitor is a tricky question. Are there other projects that perform like-kind security? Sure. I mean, any blockchain, tomorrow morning, any blockchain can have its developers start time-stamping their blockchain to Bitcoin every 10 minutes. That's not what we're trying to do. What we're trying to do is invent a new decentralized, trustless, transparent, and permissionless protocol that allows any blockchain to inherit Bitcoin's hashing power to secure itself. That's what we're building. That's what we're doing. There's nobody else in the world who offers protection using Bitcoin's hashing power with the same attributes that underpin what we believe makes Bitcoin's proof of work great.
Thank you. And with that,
Is there any
Yes.
guarantee for those chains that adopt your network, like kind of the same way that?
What's the value proposition, or do we get a Lloyd's of London to underwrite an insurance policy for the blockchain? Well, that's a good question. It's a good question. I can answer that indirectly. When we did our initial exchange offering out of Cayman Islands, we had to post a bounty with Bittrex. I think it was 28 million coins. So right now we've put up, and at the time that was a substantial amount of money. But we currently have a bounty sitting up there, so in the event that they suffer an attack, they can make users whole. So to that degree, yes, but I like where you're going. That's an interesting idea. I would even consider maybe exploring some type of an insurance policy for whoever follows it. We would guarantee that community. That's actually a really good idea.
I'll give you another one too. At the end of the day, this all comes back to consumers, right?
Fundamentally, yeah.
Fundamentally, the reason we're still having these small conversations is because consumers have not adopted.
That's correct.
The only way consumers are going to adopt is the same way they adopted e-commerce, right? Which was something like VeriSign that kind of gave you the security, the little icon, the lock icon.
Okay, that's a great question. We're actually just worked a deal with Zelcore. They're a really nice, well put together group, and they have a multi-wallet. We're also partnered with Jack's Wallet, the Decentral group, with Anthony Diorio, and we're doing just that. So early attack detection works for wallets, exchanges, et cetera, so that you could see before you send a transaction, it's flashing yellow. Hey. We developed it as think of that as the lens. You've got proof of proof. This activity's happening, right? Like right now, we're right now. Like if you have a blockchain and it's not, if you have a blockchain and it's using proof of proof, that's great. But you have to know what to look for, right? We have to be able to see. We need a lens that's going to take this data out and translate it into real-world information that we can use to make decisions. That's right, and that's what EAD is about.
That's your thing.
That's our thing, yeah. That's our thing. Well, it's.
The result is like, say you're a consumer and you have your wallet out, and someone sends you coins. Oh, thanks. Say you have your wallet out, someone sends you coins. You could look at your wallet and wait until you see a little check mark with the Bitcoin logo or whatever the branding is, right? And then oh, this is as secure as transactions on Bitcoin itself, without knowing how Bitcoin finality works and proof of proof works, and without being involved in the mining process or anything. They just know this means it's secure because Bitcoin's secure and it's in Bitcoin, right? Can I add to that? Yeah.
I liken it a lot in a wallet, and I'll be super quick. I liken it to that in a wallet, right? There's a proposed transaction fee to get your transaction in the next 10 minutes, but it doesn't mean you're going to get your transaction in the next 10 minutes, right? A lot of these things are subjective to the end user. Do you need this to happen in the next 10 minutes? Is the average fee been 10 cents? Throw $1 at it. I need to get out of here with my car. I don't care about $1 when I'm buying a $1,000 item. I want that transaction to happen because I want to go. So it's a subjective interpretation. But you can have best practices. So number one would be, if nobody's attacking the network, then it's green. If you see some competing forks because they're broadcasting up to Verablock and ultimately Bitcoin, well, there's somebody building a contending fork. Do you feel comfortable sending a transaction? If you feel safe doing that, it's subjective. You can go ahead and do that. And maybe you agree to wait a certain amount of time before you deliver the goods. So these are all subjective type things. The one thing that we can offer blockchains that do adopt us and wallet providers, mostly blockchains, is that we will be integrating with some of the top exchanges. They're going to be including EAD as part of their ecosystem because blockchains are adopting us. And when they do, exchanges are going to want to take advantage of that. How do exchanges benefit? Quite simply, right now, if you're a blockchain and you're listed on an exchange, that exchange is going to wait a period of confirmation times before they allow you to use that money on their network, right? So what happens when an exchange can instead be, let's call it Bitcoin plus one, for lack of a better term. So whatever they would give to Bitcoin, they can give to the alt chain using proof of proof or Verablock. They can give it almost what they consider Bitcoin finality, which is subjective, but they consider it final. They then allow you to use this. Now instead of having a static amount of confirmations that the exchange waits before you can use your money, it's dynamically fluctuating based on the status of the network. Is it green, red, or yellow, for lack of a better interpretation, right? So if the network's green, lower confirmation times, you can deposit your money and use it faster. That means when you see an opportunity and you want to go and speculate, you can get your money in there quicker and trade and do what you want. You don't have to wait and maybe miss that move. Or maybe you did get blocked out and you missed that move because it went the other way, and you'll thank yourself. But yeah, so we're doing exactly that. But I have to get to Maria. Thank you. You've been patient.
Thank you. And thank you so much, guys. And hopefully one day it will become as intuitive as you describe it so that it can be easily adopted. We are grateful for your contributions to the ecosystem because this is exactly what the project should be doing, building on the blockchain, testing it and seeing it and progressing. So thank you, guys. You're amazing. So now, thank you for sticking around. We are going to be raffling scope tickets, which are worth $200. They're VIP tickets, so that includes a +1. So if you can please check your tickets. I'm going to... Oh, okay, you can pick it.
A lot of pressure.
Actually, let me show you my number first.
Yes. So the winner of the scope ticket is 735182. 735182. Okay, so let's pull another number. That's funny.
We need raffle finality.
Okay, so second attempt. 735195.
Okay, I can't accept this. They're going to think we're colluding. Is that yours? That's mine, yeah. You pick the next one. Yeah. I can't participate.
Are you sure?
I just wouldn't feel right.
Okay.
If you had picked it.
Let's do the last one. This is the last one. Okay. 735181. 735181. Oh, you won! Congratulations! Great. Woo! Speak to me after this, and I'll give you your ticket. We're also going to be raffling 3 Verablock shirts, compliments to them. You can speak to them about size. So, can you pick one?
Yeah, we left them in the car, so we're going to have to run or go get them. So we were rushing to get over.
Okay, the winner of the shirt is 735178. Wonderful. Two more.
Those are worth like 200 apiece.
735184. Wonderful. And the last shirt.
They're dry clean only t-shirts.
Don't use them for PJs. All right, the last one is 735199. 735199. Okay, who wants a shirt? Raise your hand. Okay, you get a shirt. There you go. That's it. 3 shirts. Congratulations, everyone. Now, one last question. We have received wonderful Magic Leap headsets. Who here has ever tried on a Magic Leap headset? Cool. Well, they're here today for you to use. Allison over there, can you raise your hand, Allison? She's going to teach you how you can wear them, and the cool project that we're going to be looking into is called Project Create. Thank you, Magic Leap, for contributing, and thank you, Allison, for teaching everyone how to use it. So yeah, one last thing, if this is your first time here, we encourage you to follow us on Blockchain MIA in all of our social media channels, Twitter, Facebook, and Instagram. We do focus about education first and foremost to bring you this wonderful content and much more. So follow us, you can stay posted for the next editions that we're gonna be teaching here. Thank you for coming. Blockchain MIA?
Let's get you.